small and medium enterprise.
In 2013, SME definition was endorsed at the 14th NSDC meeting in July 2013. The definition covers all sectors, namely services, manufacturing, agriculture, construction, and mining and quarrying. SME Corp follow a two-tier threshold based on sector, sales turnover, and number of full-time employees. The rules that a business qualify based on whichever metric places it in a smaller size category. For the manufacturing sector, SMEs are defined as firms with sales turnover not exceeding RM 50 million or number of full-time employees not exceeding 200%. For the service and other sector, SMEs are defined as firms with sales turnover not exceeding RM 20 million or number of full-time employees not exceeding 75%. SME Corps has set a clear guidelines what defines micro, small or medium businesses based on two factors, which is annual sales turnover and number of full-time employees. In micro enterprise, a business is considered micro if it has sales turnover of RM 300,000 or less, or 5 to fewer employees. This applies to all sectors. In small enterprise, for manufacturing, a small enterprise has sales turnover between RM 300,000 and less than RM 15 million, or between 5 to fewer than 75 employees. For services and other factors, like retail or education, sales turnover between RM 300,000 and less than RM 3 million, or 5 to less than 30 employees. In medium enterprises, in the manufacturing sector, sales turnover is between RM 15 million and RM 50 million, or 75 to 200 employees. In services and other factors, sales turnover is between RM 3 million and RM 20 million, or 30 to 75 employees. And finally, if a company exceeds both of sales and employee limits for medium-sized businesses, it is classified as a large enterprise. There is also rules to classification, like sector-specific threshold, where manufacturing versus service and others, dual metric rule, where qualified by either turnover or employees count services, lower tier rule, for SME Corps, if the turnover are small but your employees count are micro, you are a micro, and vice versa. Exclusion criteria, even if size threshold are met, companies not eligible include public listed main board, firm and subsidiaries of GLCs, MNCs or large firms. There's also a real example of existing Malaysian SMEs. For micros, there are Diesel Food, small Hajah Aminah Food Industry, and medium SME Aerospace.
Current challenge affecting Malaysia's small-medium enterprises.
According to an article from Business Today on 23 June 2025, Malaysia SME face two main challenges. First, rising costs of raw materials and labour are decreased the profit margin, making it harder to invest and grow. Second, there is a digital gap. Only about 33% of smaller SME use digital tools like online payment and inventory system. Limited funds and digital skills keep them from competing effectively with larger business. This challenge makes it difficult for SME to expand and innovate. Major issue facing SME in rising operational costs. SME are facing higher costs in almost everything such as raw materials, utilities, logistics, and labor. Because small business usually have limited profit margins and cash reserve, it's hard for them to absorb these rising costs. Higher costs limit SME ability to invest in important areas. SME have to delay upgrading equipment or adopting digital technologies. To cope, they often cut marketing budget or downsize staff. This measure help them survive only in the short term. Another important issue is the digitalization gap. Larger firms and medium SME can still invest in digital tools, but smaller and micro SME often cannot. It is wide the competitiveness gap. Rising costs do not just affect daily operation, but they also weaken SME ability to adapt, grow, and stay competitive in a fast-changing economy. This creates both immediate and long-term risks, making it harder for SME to survive and innovate. Lastly, assessing rising operational costs on SME sustainability or growth.
In terms of sustainability, when costs increase like raw material, utilities, and rental, SME profit margin decrease. It is put pressure on cash flow and making it harder to pay supplier or manage inventory. This financial pressure can force small business with limited reserves to cut staff, scale down operation, or even shut down if they cannot cover basic expense. In terms of growth, rising costs force SME to spend most of their earnings on daily operation, leaving little to invest in new machinery, digital tools, or skilled staff. This limits their ability to innovate or enter new market, making it harder to stay competitive as others modernize. For example, Amalina Craft, a small handmade accessory business in Johor, is struggling with rising raw material costs and limited cash flow. This has forced the owner to delay plans for an online store and digital marketing. As a result, the business relies on walk-in customer and word of mouth, while competitors with stronger online presence can grow and reach wider markets. This shows how rising costs affect not only day-to-day survival, but also SME long-term growth and competitiveness.
Economic contribution of SMEs to Malaysia. In 2023, small and medium enterprise or SMEs continue to play a key role in Malaysia's economy. They are often called the backbone of the nation because of their big contributions to growth, jobs, and trades. Let's start with GDP. SMEs contributed 613.1 billion ringgit to Malaysia's GDP in 2023. That's a 5% increase from 2022, making up 39.1% of the total economy. This shows how SMEs are growing stronger and helping to boost the country's income. Now, about jobs, SMEs provided employment to 48% of Malaysia's workforce in 2023. That means nearly half of all working Malaysians are employed by an SME. From small shops to local factories, they help support families and reduce unemployment. And in terms of exports, SMEs are starting to gain more ground globally. While their export numbers are still growing, many SMEs are now reaching international markets thanks to better digital tools and government support. The role of SMEs across different sectors. Let's start with the services sectors, which makes up the majority of SME activity. About 89% of all SMEs are in services, around 809,000 businesses. This includes retail, food, tourism, education, and logistics. In 2023, services grew steadily, especially in wholesale and retail trade, food and beverage, and transport-related services, which grew by over 10%. Next is the manufacturing sector, home to about 5% of SMEs. These businesses focus on food processing, textiles, and metal products. Though fewer in number, they contribute significantly to SME GDP and even exports. Subsectors like food and beverage manufacturing grew by around 5%. The construction sector includes about 4% of SMEs, or over 39,000 firms. These businesses handle small to medium-scale projects, from plumbing and tiling to infrastructure work. While their GDP contribution is modest, they are essential for housing and development, especially in rural areas. Agriculture's SMEs make up just over 1% of total SMEs, but they contribute about 9% of SME GDP. Most are involved in farming, livestock, or aquaculture. Today, many are adopting smart farming tools like drones and e-commerce to boost productivity and market reach. Finally, the mining and quarrying sector has a very small SME presence, just 0.1% of businesses and 0.5% of SME GDP, but they still support local construction and resource supply in certain regions. In short, while services dominate, each sector has its own unique SME strengths.
Now, I will be presenting 3 government initiatives to support Malaysian SME, especially micro and small business. Let's begin with Tekun Nasional. This initiative is designed to provide microloans to micro and small entrepreneurs, especially those from low-income and Bumiputra communities. Many small businesses find it hard to get loans from banks due to a lack of collateral or formal documents. Tekun offers an alternative by giving them access to working capital, helping them reduce dependence on informal money leaders, and supporting the long-term sustainability of their business. In short, Tekun empowers the grassroots of our economy. The second initiative is the PSN Digital Grant. This program focuses on expanding access to funding while encouraging digital adoption and capacity building. It is targeted at Malaysian micro, small, and medium enterprise, providing them with the tools they need to grow and complete. The expected result include better productivity, greater competitive, and a stronger digital presence among entrepreneurs across the country.
Now, let's look at the SME Digitalization Grant. This initiative helps SMEs adopt digital tools by subsidizing key systems such as sales management software, inventory tracking systems, and accounting tools. The program has already supported more than 20,000 businesses across multiple sectors. With digital solutions in place, these businesses can operate more efficiently, reduce errors, and respond faster to market demands. To understand the real-world impact of these initiatives, let's take a look at Ramly Burger, a popular Malaysian brand that started as a simple street food business. With support from Tekun and Under Budget 2025, Ramly Burger transformed from a basic roadside stall into a well-known company with permanent outlets and even a factory. Thanks to micro loans and digital support, Ramly was able to improve their operations, increase production and create new jobs.
Let me highlight the difference before and after the concepts. Before the loan, Ramli was operating from basic stall with manual preparation and small outputs. After the loan, they had permanent outlets, factory scale production, and were able to hire workers. Financially, they no longer depended on personal savings or informal loans. They had access to structure and formal financing through the loan. This transformation shows how powerful microfinancing can be for small entrepreneurs.
Now, I will show you 3 reasons why credit risk evaluation reject a loan application. First, low credit score a reflection of poor credit history. If an SME has history of late payment or defaults, it suggests poor financial discipline and raises the risk of future repayment issues. Lenders should review credit report and bank statement to assess repayment behavior. Bankruptcy filings, pending lawsuit, or failure to comply with regulatory requirements, such as SSM filings, are major red flags. This issue can lead to sudden financial strain or even automatic rejection of credit application. Maxing out credit lines or overdraft indicates cash flow problem, and over-reliance on debt. Lenders should analyze the SME credit utilization ratio and cash flow statement to determine if they can handle additional debt responsible. Second, weak financial performance or insufficient cash flow. It is important to lender assess whether the SME generate enough revenue and cash flow to service the new debt. If the business shows inconsistent sales, lenders may doubt its ability to repay. If the company struggles to cover operational expenses, adding debt could worsen financial strain. Last, if the SME already has multiple loans, lender may see it as over-leverage. Lastly, lack of collateral or weak business plan for expansion. Since SME loans are often secure, lender want assurance that the expansion plan is viable and backed up by assets. Startups to untest market may struggle to get approval because banks prefer established revenue stream and proven demand. It's difficult for a conventional venture to secure funding. If the SME lack property, machinery, or receivable, it can be challenging to secure bank financing. Banks view this as higher risk because they have fewer assets to recover in case of default. A poorly structured expansion plan is a major red flag for lenders and investors. Without clear market research, realistic financial projections, and solid repayment strategy, financial requests are often rejected.
To ensure the accuracy and validity of the information presented, we have referred to the following sources as primary references.
Our online discussion group.
With that, our presentation ends this time. We would like to thank you all for your willingness to watch and listen. Thank you.